talk a little bit about the tax advantages of being a homeowner.
Yeah, absolutely. So first things first, there's two ways that we can actually own a home, right? We
Right.
can own a home as an actual primary residence, which you do get some tax
Right.
benefits through that. You can also own a home as an investment property, right? You can also have a secondary home, stuff like that. There's not a ton of tax advantages with secondary homes, but the main two I'm going to focus on today are the primary residence and then the investment properties themselves, right?
Okay.
First off, as a primary residence, there's a bunch of different things that we can do from a tax perspective. Obviously, we get the interest deduction, right? So that's a big thing that we're able to take advantage of every single year on your tax return. As you pay your mortgage, you have an interest portion that you're paying with that mortgage. That that interest portion is deductible on your Schedule A of your 1040 tax return. Okay. If you cross over the threshold or the standard deduction amount, which for 2026 or 2025, it's about $30,000. It's going to go up for a little bit with inflation in 2026. So if you go above that amount between your mortgage interest, your state taxes that you paid, and charitable contributions and a handful of other things, if you go above that $30,000 threshold, then you're able to actually take what's called itemized deductions on your tax return. Okay. So that ability to take interest from the mortgage payments as a deduction on the Schedule A, combined with the increase of the SALT cap. So the SALT cap is state and local taxes. Prior to the one big beautiful bill passing, the SALT cap was $10,000. So we were limited to how much we could take from a state tax payments, both property taxes as well as income taxes paid within the state. We were limited to $10,000 every single year when it was the Tax Cuts and Jobs Act. And so
I think we were chatting about this right before we started.
Exactly. So the one big beautiful bill bumps that cap up to $40,000. Nice. So we're able to take much more from a property tax perspective, which then obviously goes into that bucket of itemized deductions. And if you cross over that $30,000 threshold, if you're married, $15,000 if you're single. If you cross over that threshold, then you're able to take those additional deductions on your tax return. Nice. So that's a huge benefit of primary residential ownership. From an investment standpoint, there's a lot of additional opportunities that we get to use those properties and leverage the tax code to build wealth, right, and to reduce tax liability. Cool. The first main one being bonus depreciation, right? Bonus depreciation is a very popular term right now. Due to the fact that it just got bumped back up to 100%, meaning any asset that you purchase that has a useful life of 20 years or less, we're able to take 100% of that deduction in the first year that's placed in service. Nice. So when you buy a property and you do what's called a cost segregation study on it, you're able to separate out the contents of that property, which is like the flooring, the light fixtures, the appliances, as well as the land improvements, which is like the grass, the driveway, the sidewalks, the curbing, all the trees, those types of things, which is 15-year property. So we're able to peel those portions out and accelerate the depreciation aspects for those.
Is that only on a short-term rental, or is that on a...
It's a great question. So if you are classified as a real estate professional, which probably most of the listeners are not qualified as a real estate professional. If you are a real estate professional, what that means is you spend 750 hours or more in a real estate specific trade or business in which you own at least 5% of the business.
So you have to spend 750 hours per calendar year.
Per calendar year in that real estate specific trade or business. You need to have at least a 5% ownership in the business. You can't just be W-2'd. And it needs to make up substantially all of your time spent on income generating activities, which means if you have a full-time W-2 job as like a loan officer, for example, you make a W-2 job off that, and then you are a real estate agent on the side, you would have to prove that you spend more time on the real estate agent activity than you do on the W-2 job, right? So if it's a full-time job, you have to prove that you spend more than 2,000 hours on the real estate job over the W-2 job, which is almost impossible, and I don't think it's ever passed in courts. So then it leads to the short-term rental loophole, which as long as you have an average rental period of 7 days or less per tenant in the property throughout the calendar year, again on average, and you self-manage the property, then you can take those deductions against your ordinary income.